Welcome back. Today, we're tearing down the Sunday noise and focusing on the signal, a massive $50 billion deal that proves American capital is moving aggressively. But before we dive into the details, here's a quick look at the rest of yesterday's economic roundup. The big stories yesterday were Florida's housing divergence, a sign of the wealth gap, and the rising cost of your morning coffee due to tariffs and weather. Important, but localized. Now let's tackle the main event that truly shapes the future, the massive potential buyout of Electronic Arts, EA. We're talking about a staggering $50 billion leveraged buyout. The mainstream press sees risk, cost-cutting, layoffs, and short-term focus. We challenge that narrative. Our thesis: this deal is not a risk. It's a massive, bullish signal for the U.S. economy. Why? Because capital is mobilizing and seeking returns. That's the engine of economic health. The immediate impact is huge for the financial sector. Investment banks, private equity, and debt markets are surging with activity. This kind of M&A volume isn't a sign of fear. It's a sign of financial liquidity and confidence in future tech earnings. The financial structure of the deal is complex. The message is simple. Smart money sees value and is willing to bet big on U.S. technology. The gaming and tech sector is the target of the bet. A leveraged buyout forces efficiency. It forces the company to streamline, eliminate bloat, and concentrate on profitable innovation. While there might be short-term pain in non-core areas, this pressure can, long-term, lead to a more focused, more profitable, and ultimately more competitive U.S. gaming giant. The challenge to EA is to use this debt to dominate, not just survive. Your original analysis suggests a neutral to slightly negative tone due to potential cost-cutting. We fundamentally disagree. Cost-cutting is necessary corporate hygiene. The true negative would be stagnant capital sitting idle. This $50 billion proves that private equity is willing to force growth in a major U.S. tech company. This aggressive move injects dynamism into the M&A market, signaling strength, not weakness, for the broader tech sector. That's our uncompromised analysis. We laid out the counterargument. This is the sound of growth, not collapse. Now we turn to you. Is a $50 billion deal worth the risk of job cuts if it forces U.S. tech to be more competitive? Hit the comments below, like this video, and make sure you subscribe so you never miss an economic debate that matters.